Hey, YouTube family, welcome to another edition of the Kevin Strong Show. And in this video, we're going to talk about credit unions versus banks, the positives and the negatives, and where you possibly should put your money at. Welcome to the show here. I decided to dress up a little bit, wear a white shirt and a white tie. It's not necessarily indicative of my dating preference, but hey, I just figured I'd spice it up a little bit. So if you're new to my content and new to this show, please hit that like button, especially if you're laughing right now. Take a pause for the cause and smash that like button. Subscribe and comment and share because I care. So everybody's talking about the banking crisis and where you should put your money for safety. We're going to get into that a little bit. And I'm going to basically try to be as objective as possible, talking about banks and credit unions. And then at the end of this video, I'm going to give you my editorial opinion as to where your money should be and where, more importantly, what I'm doing with my money. Once again, this is not financial advice. This is just my opinion. So without further ado, we're going to go ahead and jump into this here. Let me pull the screen up here. Okay, and as you can see here, the title of this is Banks versus Credit Unions. We're going to start off with the banks and then talk about the credit unions. And as I said at the beginning of the video, we're going to wrap it up with some final thoughts. So a lot of you may or may not know, just a quick step back in history, the FDIC is an independent government agency. Once again, independent government agency, okay? That was created by the Banking Act of 1933 during the Great Depression to restore trust in the American banking system. Since then, no bank customer has lost insured, put that in quotes, right? Insured funds due to a bank failure. The FDIC is funded by premiums paid by the bank. So it's basically insurance, right? So for some of you who are not into the financial world, it's kind of like how your employer pays into workers' compensation and unemployment insurance. So in the event that you get laid off and you file an unemployment claim, that's basically the insurance for that. Well, equivalent to that from the FDIC standpoint, just imagine that the banks pay a premium to FDIC. So in the event that there is a run on the bank, that they should be able to step in with that insurance and make you whole. Every depositor is protected for up to at least $250,000. If it's an FDIC insured bank fails, FDIC insurance protects only deposits. Insurance deposits includes all traditional bank accounts such as checking, savings, excuse me, guys, and CDs. So here's the important part about this slide that I wanted to convey to you guys. 250 billion. That's how much money is in FDIC to cover almost $700 trillion of commercial deposits. So as I've said in previous videos, the FDIC, for all practical purposes, is insolvent. So in theory, if everybody goes for a run on the banks, they don't have enough money to make you whole. Obviously, 250 billion does not cover it. So what are some of the banking issues? Banks have always been viewed as evil and untrustworthy. We've seen numerous things about fake accounts that were put up by Wells Fargo, electronic online glitches where depositors don't see their balance show up for a day. And then when you call into your bank, they say that it's a technical difficulty. Who knows what's really going on with that behind the scenes? Disconnected from customers due to automation. So when you need to talk to someone, you got to go through all these automated prompts. It's very frustrating. One specialist can't give you information about something else, so they have to transfer you over to that department to start that automation process all over again. It's very frustrating. Reserve requirements, ladies and gentlemen. As announced on March 15th, 2020, the board reduced reserve requirement ratios to 0% effective March 26th of 2020. So what is that for those of you who don't know? Back in the day, there was something called fractional banking where the government required these institutions to require or to keep some money on hand in relationship to the amount of their deposits. So what this is basically saying, March 26th of 2020, they moved that fractional requirement to 0, which basically says in layman terms, you don't have to keep any reserves in your bank. You can just loan over and over and over again. So once again, as a quick recap, the fractional system used to be, hey, let's just say for every dollar that the bank got in, they probably were leveraging that 50 to 100 to 1. but they took that requirement off altogether in the first quarter of 2020, buying low interest T-bills and getting caught when the rates went up. So this is what happened to some of these regional banks and larger banks. So to keep this simple, back in the day when the Fed had interest rates really low, we've been on basically low debt for the last 14 years, since 2008, 2009, they were buying bonds, let's just say for simple math, at 1%, hundreds of millions of bonds at 1%. Then over a period of time, that was okay. But then when the healthcare crisis happened, and then they started to raise the bond rate to, let's say, 3%. You bought 3 years ago at 1, but now it's 3. And now there's a run on the bank, and you don't have those reserves on hand, because remember, they removed fractional reserves back in 2020. So now that you have these long-term bonds and this heavy deposit demand saying, I want my money, you have to pay back or cash in those bonds, even though the prevailing market rate is significantly higher. So you're selling your bonds at a discount, at a loss, to satisfy the deposit demands. And that's why it's a run on the bank, and it's collapsing a lot of things, because all of these banks, whether they're small, regional, or international, they're all connected either directly or indirectly. And last, certainly but not least, in terms of a banking issue, heavy exposure to the mortgage industry. There's a very, very strong opinion on one side or the other, no pun intended, about whether or not we're in a mortgage crisis or housing crisis. I think clearly we are, but I think the foreclosure crisis is going to really start to pick up in the second quarter of 2023, and that will have a direct impact on some of these regional and larger banks, because they get a lot of their profit through mortgage lending. Okay, now we're going to transition quickly into credit unions. The National Credit Union Administration, NCUA, is the equivalent of FDIC. So this is the entity charters and regulators federal credit unions and insures credit union deposit accounts. With NCUA protection, even if your insured credit union fails, deposits you've made into your account are protected up to $250,000 per person and ownership category. So once again, for a quick recap, this is the equivalent of FDIC. I'm going to show you some information about the solvency of this particular part of the credit unions. It's a little bit, I shouldn't say a little bit, a hell of a lot more solvent than FDIC. But once again, all of this stuff is very, very it's connected. Okay, this is going to be really kind of hard to see, but this is something that I got. This is an aggregate of all the credit unions in the United States. So I like to draw your attention to, let's just say you got the members, is roughly 135.3 million credit union members throughout $7 trillion. If you go to the first blue highlighted information where it says return on average assets, 89 basis points. Okay, and then we're going to move 2 lines below that where it says annualized. It says 18.9 billion. I'm going to slow up for you guys who need to follow. And then the net worth ratio is 10.74. So that's important. Net worth ratio, 10.74. Just for general purposes, a net worth ratio of 7% or greater is considered well capitalized. Okay, solvent at this point in time. So this is some information I got directly from the national website. As you go down to the loan portion, as you can see, total loans are about 1.5 trillion. The average loan balance right below that's about 17,000, and the loan to share ratio is about 81%. Now it shows that they're heavily in mortgages, but I think that balance of 17,000 is probably more indicative of auto loan balances, because credit unions do a lot of automobile loans. Now that industry is going to get hit, and hit very, very hard. However, on average, credit unions don't do exotic lending or high-risk loans. So I think the solvency of credit unions overall will be or should be able to handle the onslaught of automobile delinquencies, but only time will tell. Okay, what are some of the issues with the credit union? Membership is obviously required. Credit unions require their customers to be members. They don't necessarily have the best rates when it comes to, you can probably find a higher annual percentage, APY, on a share certificate or savings account, or on a lower rate on a loan at an online bank. So I'm going to push back on that a little bit. It depends on what credit union, but generally speaking, I think you get some really attractive rates, especially when it comes to auto loans, when you compare getting an auto loan, let's say at a really solid credit union, or an interest rate on a used automobile. They've got really, really competitive rates when it comes to that. Limited accessibility. Credit unions tend to have fewer branches than traditional banks and may offer fewer products and services. Smaller credit unions may not offer as many loan and deposit products as a bigger credit union, or let's just say a bank. Key points moving forward. Mortgage defaults, I think, will have a bigger impact on the regional and bigger banks because that is one of their mainstream or streams of income for profit. Regional banks are vulnerable to commercial real estate defaults. Now, this is a big deal. I know this is kind of a long video, but I wanted to spend some time talking about this credit union stuff and these banks. I've got some information here. There's like $250 billion of commercial loans that's due to reset in 2023. So what I mean by that is when you take out a commercial loan, it's amortized over 25 years, but the rate is only fixed for maybe 3, 5, or 7 years. And then it has to be basically refinanced. What's happened, a lot of these institutions took out a lot of loans when it comes to a lower interest rate 2 or 3 years ago. And now that interest rates have gone up, they're looking at, hey, I borrowed maybe $100 million at 4%. Now we're looking at 7, 8. I'm not getting as much rent. Office space is basically just dead in the commercial space. And a lot of the rents are getting compressed. The cap rates for those who follow that are getting squeezed as well. So it's a perfect storm in a bad way for commercial real estate because they borrowed so much money 2 or 3 years ago at low rates, and now they have to refinance. You either have to bring money to the table. You are mandated by the language in that loan that you have to refinance. So you can't push the can down. So that is an explosive, toxic situation that is going to hit a lot of regional banks that typically deal with lending at the commercial level. Credit unions traditionally do not take on risky loans like the banks. So in summary, if you're looking to reduce your exposure to the ongoing banking crisis, consider a strong, solvent credit union. This is not financial advice. This is just my opinion. And consider purchasing T-bills directly from treasurydirect.gov. I know many experts say that the big banks are the way to go, and they're basically saying that the Fed probably wants to push everybody into big banks so they can consolidate all the banks, but I don't know if I necessarily agree with that. I think just look at history with some of these bigger banks. They've been caught with fraud, criminality. You don't have access to your account. You get these online glitches where you don't have access to see your deposits for almost 48 hours. You just don't hear stuff like that historically associated with the credit union. So that's why, even though it may be popular that a lot of people are saying, I'm going to push my money into the bigger banks because it's safe, I personally believe that under the credit union scenario, that you've significantly reduced your exposure to a bank run. And I think more importantly, the psychology behind a credit member is a little bit different from the bank. People really trust their credit unions, their relationships at those banks levels. And I think you're less likely to see a run on the bank from a credit union perspective, opposed to a regional or bigger bank where there's no loyalty at all because of all the things I mentioned, right? Automation, no access to a real person, and that human touch that's been removed from the banking experience is why so many people, excuse me, just don't trust the banks. So wanted you guys to kind of get some information about that. Hopefully that helps you make an informed decision. Sit down with your significant others and make a decision that's good for you and your family. You know my slogan when I say keep your credit score up and your debt down. And I like to leave you with a little proverb. And where did I put that at? Tomorrow belongs to the people who prepare for it today. This was the Kevin Strong Show. Once again, if you have not subscribed to my channel, I humbly ask for your hand on the like button and hit that subscribe. Please comment and share because I care. This was the Kevin Strong Show, and I'll see you guys in the next video.